This video is about balance sheet reconciliations for fixed assets and is another video in my series on balance sheet reconciliations. I've linked the YouTube playlist for these balance sheet reconciliations above. In this video, I'll also discuss various aspects of managing fixed assets like fixed asset purchases, inventories, disposals, write-downs, materiality thresholds for assets, and business property tax returns. That sounds like a lot, but I will cover it step by step. Hidden chaos of fixed assets. Can you relate to that statement? Here's some of the issues that accountants must be aware of when managing fixed assets. I've worked for very small companies as well as medium and large corporations as an accountant, controller, and VP of accounting. In some of these companies, there was a team of over 50 accountants just managing fixed assets, from the initial planning of new buildings to the construction and subsequent maintenance or significant build-outs. Most medium to large companies have fixed asset modules in their ERP software, and that saves time. But there's still so much more manual work that accountants track outside of the system. And it is very complex because of the significant number of either construction projects or number of fixed asset purchases. In small companies, in my experience, fixed assets are often tracked in Microsoft Excel, and the complexity of managing fixed assets lies in being able to locate assets because IT or other teams don't tag or update asset tags and don't necessarily understand the impact on accounting processes. Sometimes fixed assets are purchased on credit cards without good documentation. Perhaps these assets were needed for a trade show, or it can be difficult to receive notification of disposals or redeployments, or to figure out who is responsible for fixed asset inventories and documentation that assets are disposed of. It starts with the difficulty of tracking all fixed assets, especially if they're below the threshold that your company has for capitalization. It can also be difficult to properly capture all fixed asset costs, especially if there is setup and configurations involved in making the asset ready for service. Computer equipment is notoriously difficult to track because IT often takes back equipment and redeploys it without any notification to accounting. The same applies to the retirement of fixed assets and impairments for that matter. Who is responsible for fixed asset tags and the inventory? Is it accounting, the property management team, or multiple teams? How do you handle missing assets? Who is responsible for determining that assets can be written off? The accountant manages the balance sheet account reconciliation, but with all the known issues, how do you really certify that it is the correct representation of a company's fixed assets? A critical aspect of managing fixed assets is, of course, internal controls and SOX controls. In addition, there is the business property tax that is paid on the asset purchase price, not the book value, which makes it critical to determine what assets are still in service or continue to pay business property taxes. What other issues have you encountered in managing the fixed assets of your company? Let's start with the process of the balance sheet reconciliation. Just as a reminder, this is the four-step process for preparing balance sheet reconciliations. The first step is to obtain reports from your accounting system. The second step is the process of reconciling the general ledger account to the subledger. The third step is the process of preparing the account reconciliation, which includes the cover page, the GL detail, and the subledger. Finally, in step 4, you're reviewing the reconciliation one more time and signing off on it. Subsequently, the reviewers will also review and sign off on the reconciliation. That level of sign-off can depend on how material the account is to the overall financial statements. The first report that is needed to prepare the balance sheet account reconciliation is the general ledger for the balance sheet account you're reconciling. You'd obtain that GL report from the company's accounting system. Ask someone on your team for the query if you're not sure where to find it. The GL report should show the balance at the beginning of the month, activity for the month, which could be just a few debits or credits, but can also include hundreds or even thousands of transactions, and the ending balance. In QuickBooks, click on Accountant Tools, click on Reports, and then scroll down until you get to the section called For My Accountant. That's where you'll find the General Ledger report. You can also use the QuickBooks Transaction Detail report and filter for the account, or you can run the QuickBooks Balance Sheet report and drill down on the specific account balance for the detailed GL report. So there are a few different ways to obtain the General Ledger report. For this video, we're going to work on the balance sheet account reconciliation for ABC Company and various asset accounts that I set up for fixed asset purchases, the related accumulated depreciation and amortization, as well as the depreciation expense and amortization expenses. I used the transaction detail report and customized it to only include the columns that were meaningful for the reconciliation, and filtered it for all the accounts that I want to include in the account reconciliation. The transaction detail report is too long to show all of the rows, but you can see the header, which shows that this report is for January to May 2025, some of the activity for the period, and the total amount of $358,057. The activity shows all fixed asset opening balances, purchases, and accumulated depreciation and amortization for those 5 months. Normally, I would run the trial balance if the reconciliation only involves 1 or 2 accounts, but in this case, it's more convenient to use the balance sheet because it readily shows me the subtotal for fixed assets, which agrees with the general ledger or transaction detail report. If I use the trial balance report, I'd have to add up all of the account balances manually. The balance sheet confirms that the transaction report is a good source for our reconciliation because it shows the same amount. We now either generate a subledger report from the system if there is a fixed asset module in your ERP or you have a separate fixed asset software program. But in this example, I'm showing you how I prepared a manual subledger report. A fixed asset system report would look somewhat similar in that it would show you the asset description, the date purchased, accumulated depreciation and amortization, and the net book value. So let's look at this manual subledger report. Moving from left to right, I have the account number, account name, the asset description, date purchased, and the purchase price of the asset, the useful life, a column for the date of the disposal of the asset, even though I haven't used it here, and then the prior year depreciation, and a column for each of the month of the current year depreciation. There's a total for the current year, and the beginning of the next year, I would use the group option in Excel to hide all monthly columns have only the total for the year remaining. The accumulated depreciation amortization column reflects all inception to date depreciation and amortization. The next column for disposal is only used if you have a disposal, which then would deduct the purchase price and accumulated depreciation. The last column is the net book value, meaning purchase price minus the depreciation or amortization. So when we add a new asset, we add an additional row at the bottom of the asset section that the new asset belongs into and start the depreciation in the month it was purchased. For instance, the purchase of a computer on March 25th, 2025 for $1,500 has a starting depreciation in the month in the March column with $25, which was calculated by dividing $1,500 by the useful life and then by 12 to arrive at the monthly depreciation. Fixed asset schedules can be difficult to maintain and update because it's really easy to make a mistake when adding a new asset or updating the schedule for the new year. My first tip is not to insert a blank line when adding a new asset, because then the subtotals for the fixed asset category will not include that row that you just added, resulting in you having to manually update all sections. It's better to copy the last row and then insert it above that row so that you now have two rows that show the same data. Check your total, they all include the last row. That's the beauty of it, and you can now update the last row for your new asset. That's tip number one. Do not add a blank line. Instead, copy the last row and insert it above the last row so that all formulas are automatically updated. Tip two is to use the round formula for your depreciation, because otherwise you will be looking for penny variances as you're booking your monthly depreciation or amortization. This subledger report is a pretty basic example. Companies often add a lot more asset information, such as, for example, cost center or department numbers, so that reports can be generated for the cost center managers. In addition, the state and city where the asset is located is added, as well as the tag number, and the name of the asset owner is added as well. This manual subledger report is probably sufficient if your company does not have more than 10 purchases a month. But the more fixed asset purchases you have, the more an integrated fixed asset module in your ERP system or a standalone fixed asset software program makes sense. That brings us to step 2 of the 4-step process, which is to reconcile the account. That means that you compare the total from the GL detail or transaction detail report to the subledger report. My transaction detail report shows a total of $358,057, and the subledger report shows the same. The income statement should also show the total depreciation and amortization for the year. I've mentioned this before, but I think it's worth repeating. Auditors typically prefer system subledger reports rather than manually prepared ones. Auditors believe that a system report is more accurate because it went through system testing when it was implemented. In addition, it's also a lot more work to prepare a subledger report, especially if there are a lot of transactions. That is why it is a good idea to watch out for opportunities to have the IT team prepare subledger reports for the accounting team. System implementations and updates where the accounting team has to provide requirements and test cases are often a good opportunity to sneak in a requirement for a subledger report. It won't always be approved, but if you don't ask, the answer is no. And we're now ready to move on to step 3 of preparing the reconciliation. Step 3 now consists of preparing the reconciliation by updating the cover page for the date in the header, the general ledger balance, and the subledger balance. Tab A is updated by copying and pasting the new general ledger detail, and tab B is updated with the subledger report that we created as of May 31st. I've found that it saves you a bit of time by using VLOOKUP or XLOOKUP formulas in the cover page that automatically pull in the information from the general ledger tab and the subledger tab. The month close process is a rush typically, so any time saved by automating things will make a difference. For instance, the formulas I use to pull in the general ledger and subledger balances are shown here. Be sure to double check that there is no difference between the GL and the subledger. Enter any notes if applicable. Also, I found that it's a good idea to maintain a balance sheet reconciliation checklist. You're likely to be in a rush when preparing the reconciliation, and even if you're not in a rush, it's easy to overlook steps in a routine activities. So a checklist will help you to double check your own work. The final step is to look over the details of the reconciliation one more time and then sign off on it at the top of the reconciliation cover page. As I mentioned, add any notes that will help the reviewer to understand the reconciliation. Especially if you have done any research on any of the items in your reconciliation or any follow-up, don't keep it to yourself. Add that information in the notes section. Both the preparer and the reviewers need to sign off. The number of reviewers depends on your sign-off policy. It is not uncommon for complex and very material accounts to be signed off by multiple reviewers or for the accounting team to update other teams about the reconciliation, especially if the account involves complicated estimates, calculations, and assumptions. Many companies also have internal and SOX controlled checklists that need to be updated in addition to updating the balance sheet reconciliation tracker. I have a separate video about the importance of the balance sheet reconciliation tracker and why it is crucial to maintain one for a successful month close. Now that I've talked about the process of reconciling fixed asset accounts, let's talk about the challenges of fixed assets. Earlier in the video, I introduced these issues as the hidden chaos of fixed assets. Let me now talk about how to potentially address these issues. Most companies have accounting policies that cover a lot of these topics. If your company doesn't have one, it might be a good idea to at least document the assumptions or even write a policy. You'll likely find a good policy online and ask ChatGPT for a sample policy. Many companies have a materiality threshold, and according to ChatGPT, the threshold ranges from $1,000 for a small company to over $10,000 at a large company. I have not seen a $10,000 materiality threshold for fixed assets, even at the large companies I work for. So there can be a range of amounts. In either case, the assets below this threshold are immediately expensed and are pretty much below the radar of tracking them unless another team such as IT keeps track of them. Which brings us to the other topics of assets being redeployed, retired, or impaired, and for that purpose, really the next few items as well. Who is responsible for communicating what happens to the assets that have been capitalized? In some companies, I've seen cost center managers receive a fixed asset list of all assets assigned to their cost center, and there's a requirement to verify who has the assets. IT accounts for a lot of the technological assets, such as computers, but what about all the other fixed assets? Is there a property management department that will track them and inform accounting when assets are moved, impaired, or retired? For that purpose, who will be responsible for the asset inventory if one even is done? How do you identify missing assets, and who ultimately signs off that the assets can be located, giving the accounting team the go-ahead to dispose of them? One company I worked for had the policy of automatically writing off fixed assets at the end of its useful life, because at some point a study had been completed that by the end of the useful life, these assets had already been disposed of. If you work at a large company, these topics may have already been worked out and are properly documented in the accounting policy and desktop procedures, but that's not always the case. And if you're the one in charge of managing the accounting team, it is good to get guidance from your external CPA firm and start working on each of these issues. That's it for this video, and I hope you found it helpful and informative. Let me know if you have any questions or share your experience in managing fixed assets.